Three countries, three very different governments, one very similar move. And if history is any guide, by the time most people figure out what they're actually doing, the window will already be closed. Today, we're connecting the dots between a Russian budget document, an Indian banking rule that kicks in April 1st, and a quiet purchase by a Middle Eastern central bank that hasn't touched this asset in over 50 years. The asset? Silver. And no, this isn't a silver is going to the moon clickbait video. I'm going to show you the actual documents, the actual numbers, and let you decide what it means. Stay until the end, because the third piece of this puzzle is the one most people completely miss, and it might be the most important one. Before we dive in, nothing in this video is personal financial advice. I'm here to break down what's happening, what analysts are saying, and what tools you have available. Always do your own research and speak with a qualified advisor before making any investment decisions. First, let's get everyone on the same page. Before we get into the sovereign moves, let's make sure we're all on the same page, because if you're new here, silver can seem confusing. Here's the simple version. Silver is not just jewelry, and it's not just coins that your grandpa kept in a drawer. Silver is one of the most industrially important metals on the planet. It conducts electricity better than any other metal in existence. That means every solar panel, every electric vehicle, every smartphone, every AI data center uses silver. There is no substitute that works as well at scale. Now here's where it gets interesting. Silver comes from the ground, obviously. But here's the catch. About 70% of all silver mined globally is actually a byproduct of mining other metals, copper, zinc, lead. That means silver miners can't just decide to produce more silver when demand goes up. It's tied to the production of completely different industries. So you have rising demand on one side and supply that can't respond quickly on the other. That's called a structural deficit. And according to the Silver Institute, an industry body that tracks this, 2026 marks the sixth consecutive year of silver demand outpacing silver supply by roughly 67 million ounces. Think about that. 6 years in a row, more consumed than produced. Now, why hasn't the price reflected that more dramatically? Great question, and that's exactly where our three countries come in. Keep watching, because what Russia did in November 2024 is something no major country has done in decades, and the finance world barely noticed. The Russian move, first major power to put silver in national law. Let's start with Russia, because this one is the most documented. It's not a rumor, it's not a prediction. It's written into federal law. In November 2024, Russia passed federal law number 419, which allocated 51.5 billion rubles every year from 2025 through 2027 for the acquisition of precious metals for the National State Reserve. Now that's roughly $535 million US dollars per year. At current exchange rates, potentially up to $640 million. Here's what makes this unprecedented. Silver is explicitly named in that law, alongside gold, platinum, and palladium. Russia is the first major sovereign nation in modern history to officially add silver to its national strategic stockpile. Not as a side note, in the budget, every year, for 3 years. The official wording from the Russian Ministry of Finance, and I'm translating this directly, says the goal is to, quote, ensure a balanced federal budget and stable economic development, as well as meet the industrial needs of the Russian Federation in the event of an emergency. That last part is key. Industrial needs, emergency preparedness. They're not just treating silver as a financial hedge. They're treating it as infrastructure insurance. Now, how much silver are they actually buying? That's where it gets murky by design. Russia is under heavy international sanctions. They're not broadcasting their purchase volumes. The 51.5 billion rubles is a pooled budget across multiple metals and gemstones. Analysts estimate roughly 10 to 20% of that budget could be going to silver, which works out to somewhere between 700,000 and 1.7 million ounces per year. Over 3 years, potentially 2 to 5 million ounces total. In a market already running a 67 million ounce deficit, that matters. Importantly, Russia produces about 38.5 million ounces of silver domestically every year. They have the internal supply. They're choosing to hold it rather than sell it. That's a very different signal than just being a buyer. Now, Russia acting alone could be dismissed as geopolitical maneuvering. But what happens when you layer on what India is doing? Because what India announced doesn't just affect governments, it affects 1.4 billion people. The India factor, remonetizing 25,000 tons of household silver. India has a silver secret that most Western financial analysts completely underestimate. Ordinary Indian households, not banks, not institutions, are estimated to hold over 25,000 tons of silver. Jewelry, coins, ornaments passed down through generations. This silver exists largely outside the formal financial system. It's not tracked, it's not collateralized, it just sits there. Until now. Starting April 1st, 2026, just days from when you're watching this, new Reserve Bank of India rules officially allow silver jewelry, ornaments, and coins to be used as collateral for bank loans. At a 10-to-1 weight ratio compared to gold. Let's unpack what that means in plain English. If you have silver sitting at home in India, you can now walk into a bank and borrow money against it, legally, formally, with documentation. This does two things simultaneously. First, it creates instant demand pressure. People who want liquidity will now hold on to their silver rather than sell it. Why sell an asset when you can borrow against it and keep ownership? This pulls silver off the market. Second, it remonetizes silver. It brings it back into the financial system as a recognized store of value. Not just a metal, not just a cultural artifact, but actual financial collateral. And this is happening in the world's largest silver-consuming nation. India is not a small player here. When you combine Russia locking silver into a national strategic reserve on one end, and India essentially reclassifying silver as a bankable asset for over 1 billion people on the other end, you start to see a pattern. But the third country, this one surprised even seasoned precious metals analysts. Because this country hadn't touched silver as an investment in over half a century, until quietly, in 2025, they did. The Saudi signal, when oil money moves into silver. In the second quarter of 2025, the Saudi Arabian Central Bank quietly disclosed a position in SLV, the iShares Silver Trust ETF, along with positions in silver mining ETFs. The total value? About $40 million, roughly 90 tons of silver equivalent. Now, for a sovereign wealth fund that manages hundreds of billions of dollars, $40 million is basically a rounding error. So why does it matter? Because Saudi Arabia hasn't made a move like this in over 50 years. Since the 1970s, Gulf central banks have operated almost exclusively in gold and US dollar assets. Silver wasn't part of the playbook. Not publicly, not officially. This purchase doesn't represent a massive strategic shift, but it represents something more important in the world of institutional finance. A signal, a test position, a toe in the water. In the investment world, when a sovereign wealth fund takes a new position in an asset class they've ignored for 50 years, analysts pay attention. Not because of the size, but because of what it implies about their internal research, their forward-looking models, and what they expect to happen next. The precedent is set. If one Gulf nation moves, others notice. They all share research. They all watch each other. 3 actors, 3 different motivations, 1 asset. The price picture, where silver actually stands right now. Let me give you the honest price picture, because this is where I want to be really clear with you. Silver hit an all-time high of around $121 per ounce in January 2026. That's real. That happened. As of mid-March 2026, It's sitting around $76 to $80 per ounce. That's a drop of roughly 30% from those January highs. Why did it drop? Mostly macro reasons that have nothing to do with silver fundamentals. The US Federal Reserve held interest rates higher than markets expected. The dollar strengthened. Investors moved away from commodities broadly. Classic risk-off behavior. Here's how to think about this if you're new to markets. Imagine you're selling lemonade and your fundamentals are great. Everyone wants lemonade and you're running low on lemons. But then it starts raining. People stay inside. Nobody buys lemonade that day. Did lemonade get worse? No, the weather just changed temporarily. That's roughly what's happening with silver right now. The underlying story, deficits, industrial demand, sovereign buying, hasn't changed. The macro weather got stormy. Where do analysts see it going? Honestly, the range is wide. JP Morgan projects an average around $81 for 2026. Solid, but conservative. Bank of America has modeled scenarios from 135 all the way to 309 based on how much the gold to silver ratio compresses. Some very bullish technical analysts are calling for $300 or more by mid-2026. More conservative voices say we could see 60 to 70 if macro headwinds persist. The honest answer is nobody knows exactly. And anyone who tells you they do with certainty is selling something. What we can say is that the structural foundation, deficit sovereign interest, industrial demand is real and documented. That doesn't guarantee any specific price, but it does tell you why this conversation is happening at all. The $250 scenario, math, not magic. So where does $250 come from? Let me show you the math, and you can decide if it's realistic. There's a metric called the gold to silver ratio. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio sits at around 62 to 1, meaning gold is 62 times more expensive than silver. Historically, over centuries of data, that ratio has averaged around 40 to 1 in normal times. During financial crises or monetary resets, it has compressed all the way down to 15 or 16 to 1. Today, gold is trading around $5,000 per ounce. If gold stays at $5,000 and the ratio simply returns to its long-term average of 40 to 1, silver would be at 125. If the ratio compresses to 20 to 1, not unprecedented, but aggressive, at 5,000 gold, silver sits at 250. That's the math. It doesn't require any crazy assumptions about a monetary collapse or a supply chain disaster. It just requires the ratio to mean revert. Now, what would trigger that kind of ratio compression? Exactly what we've been discussing. More sovereign buyers entering the market. India's collateral effect, pulling physical silver into the financial system. Industrial demand continuing to grow from solar and EVs and AI. And a deficit that's now in its 6th consecutive year. Is 250 guaranteed? Absolutely not. Is the math that gets you there logical and documented? Yes, it is. What to actually do with this information? Look, I want to be straight with you, especially if this is your first time thinking about silver as an asset. The purpose of this video isn't to tell you to go buy silver tomorrow. The purpose is to show you that real, documented, policy-level moves are happening in sovereign nations, and that those moves have historical precedent in reshaping how an asset is valued. Russia has put silver into national law. India has given silver formal financial status for over 1 billion people. Saudi Arabia made its first silver purchase in generations. These aren't Reddit theories. These are government documents and regulatory filings. What you do with that information is entirely up to you. If you want to learn more about how silver fits into a broader investment picture, I'll link some resources below, including where to track live silver prices, how to read the deficit reports from the Silver Institute, and the best explainers on the gold to silver ratio. If this video helped you understand something you didn't before, that's the goal. Drop a comment below and tell me what surprised you most. And if you want me to go deeper on any one of these three countries, a full breakdown on the India collateral rules, the Russian budget documents, or the Saudi ETF position, comment below and I'll build that video next. Subscribe if you're not already. We cover this stuff every week with actual sources, not guesswork.